Every successful business evolves. And to keep up, you need a bank relationship that evolves too. When you collaborate with KeyBank, you don't get one-size-fits-all solutions. Our expansive team of experts across industry verticals wouldn't be here if you did. Always ready with bespoke solutions for your biggest challenges and opportunities. We know all businesses are different, and that's why we approach business differently. Reimagine business as usual. KeyBank opens doors. Learn more at key.com/B2B.
I'm not giving up.
I am selling the building.
The final season of FX's The Bear.
The restaurant is flooded.
Everything's either gonna be okay.
No, stop!
Or not.
We are outgunned and we are outmanned, but we have each other.
FX's The Bear, the final season. All episodes now streaming on Disney+.
Welcome to Learn Finance 101, where we break down the key historical events within finance and economics. In this episode, we turn to one of the most dramatic, psychologically revealing, and culturally resonant episodes in the short but extraordinarily volatile history of cryptocurrency. The 2022 crypto winter and the spectacular, almost cinematic collapse of FTX in November 2022. This is the story of how the cryptocurrency market, after a euphoric bull run in 2020 to 2021 that saw Bitcoin surge to nearly $70,000, Ethereum to over $4,800, and the total crypto market capitalization exceed $3 trillion, plunged into a brutal multi-year winter that erased more than $2 trillion in value. It began with over-leveraged bets, algorithmic stablecoin failures, hedge fund liquidations, and cascading contagion in spring and summer 2022. But the crisis reached its explosive climax in November 2022 with the bankruptcy of FTX, one of the world's largest crypto exchanges, and the revelation that its founder, Sam Bankman-Fried, had allegedly misused billions of dollars in customer funds to prop up his sister trading firm, Alameda Research. The collapse exposed frauds, hubris, regulatory gaps, and systemic weaknesses in an asset class that had promised decentralization, financial freedom, and a hedge against traditional finance, but often delivered speculation, scams, and heartbreak on a massive scale. The crypto winter ruined retail investors who had bought at the top, toppled billionaires who had become celebrities, destroyed once dominant institutions, and forced governments and regulators around the world to confront the reality of a financial ecosystem that had grown too big, too fast, and too loosely supervised. Yet, like many bubbles before it, the winter cleared out the weakest players, forced painful but necessary maturation, and laid the groundwork for a more resilient, if still volatile, crypto landscape that continues to evolve in February 2026. In this extended episode, we will walk slowly and methodically through the origins of cryptocurrency and the early booms and busts that set the stage, the manic bull run of 2020 to 2021 that pushed crypto into mainstream consciousness, the early warning signs and cascading failures of spring and summer 2022, the explosive FTX collapse in November, the immediate fallout and criminal investigations, the long and uneven recovery into 2023 to 2026, the human and economic toll on millions of participants, and finally, the enduring lessons that still guide investors, developers, and regulators navigating this space today. Let's begin by stepping back into the early days of cryptocurrency, when a mysterious white paper sparked a revolution that would eventually lead to both euphoria and devastation. Cryptocurrency's origins trace to October 31st, 2008, when someone, or perhaps a group, using the pseudonym Satoshi Nakamoto, published a 9-page white paper titled Bitcoin, a peer-to-peer electronic cash system. The paper proposed a decentralized digital currency that would operate without banks, governments, or any central authority. Transactions would be verified by a network of computers using cryptography and recorded on an immutable distributed ledger called a blockchain. The Genesis block of Bitcoin was mined on January 3rd, 2009, and embedded within it was a now famous message. The Times March 3rd, 2009, Chancellor on brink of second bailout for banks. A clear political statement aimed at the failures of traditional finance during the global financial crisis. Bitcoin began as a niche experiment among cypherpunks, libertarians, cryptography enthusiasts, and early adopters who valued privacy, decentralization, and resistance to censorship. In the beginning, it had almost no monetary value. The first real-world transaction occurred on May 22, 2010, when a programmer named Laszlo Haniec paid 10,000 BTC for 2 pizzas, an event now celebrated annually as Bitcoin Pizza Day. Those 10,000 BTC would be worth hundreds of millions of dollars today. By 2013, Bitcoin reached its first major milestone, $1,000 per coin, amid growing media attention and the notoriety of the Silk Road dark web marketplace, which used Bitcoin for anonymous transactions. The 2017 bull run marked the first widespread retail mania. Bitcoin surged from under $1,000 at the start of the year to nearly $20,000 in December 2017. Ethereum, launched in July 2015 by Vitalik Buterin, rose from $8 to over $1,400, introducing smart contracts, programmable code on the blockchain that enabled decentralized applications, dApps, and the initial coin offering ICO craze. Thousands of new tokens raised billions through ICOs, many of them little more than white papers with no working product. China banned ICOs and crypto exchanges in late 2017, and the market crashed in 2018, losing 80% of its value. Bitcoin fell to $3,200, and the term crypto winter entered the lexicon. The recovery began in 2019, but the real explosion came in 2020 to 2021. COVID-19 stimulus flooded global economies with liquidity. Interest rates were slashed to near zero. Investors sought high-risk, high-reward assets. Bitcoin surged from under $10,000 in early 2020 to $69,000 in November 2021. Ethereum reached $4,800. The total crypto market capitalization briefly exceeded $3 trillion. NFTs exploded. CryptoPunks, Bored Ape Yacht Club, and Beeple's digital art sold for $69 million at Christie's. DeFi platforms like Uniswap, Aave, and Compound promised bankless lending, borrowing, and trading. GameFi projects like Axie Infinity let players earn crypto tokens through play-to-earn mechanics. Institutional adoption accelerated. Tesla bought $1.5 billion in Bitcoin in early 2021. PayPal enabled crypto trading. Coinbase went public in April 2021 at an $86 billion valuation. The narrative was intoxicating. Crypto was the future of money, a hedge against inflation, a tool for financial inclusion in developing countries, and a path to generational wealth. Celebrities endorsed tokens, Super Bowl ads promoted exchanges, social media was flooded with to-the-moon memes. Retail FOMO reached fever pitch. Millions of people bought on apps like Robinhood, Coinbase, and Binance, often with borrowed money or life savings. But the foundation was fragile. Many projects were speculative or outright scams. Leverage was rampant. Perpetual futures on exchanges like Binance and FTX allowed traders to bet with 100 times leverage. Stablecoins like Tether, USDT, and algorithmic Terra USD, UST promised dollar parity but carried hidden risks. Centralized exchanges held customer funds in ways that resembled traditional banks, without the same oversight or insurance. The first major cracks appeared in early 2022. The Federal Reserve signaled aggressive rate hikes to combat inflation. Bitcoin and Ethereum began declining from their November 2021 peaks. Then in May 2022, the Terra/Luna ecosystem collapsed. Terra USD, UST, an algorithmic stablecoin meant to maintain a $1 peg through arbitrage with its sister token Luna, broke its peg. As confidence evaporated, users rushed to redeem UST, forcing the protocol to mint trillions of Luna tokens, which crashed from $80 to fractions of a cent. The total wipeout exceeded $40 billion. Hedge fund 3 Arrows, Capital 3AC, heavily exposed to Luna and other crypto bets, liquidated in June 2022 with losses over $10 billion. Crypto lenders Celsius and Voyager froze withdrawals in June and July 2022 and filed for bankruptcy shortly after. Contagion spread. The climax arrived in November 2022 with FTX. Founded in 2019 by Sam Bankman-Fried, SBF, a 29-year-old MIT physics graduate and effective altruist, FTX had grown rapidly to become the second or third largest crypto exchange by trading volume. SBF marketed FTX as the safe, regulated, transparent alternative to competitors like Binance. He lived in a luxury Bahamas compound with a group of colleagues, dated fellow executive Caroline Ellison, CEO of Alameda Research, and donated hundreds of millions to political campaigns and charities under the banner of effective altruism. Behind the scenes, the reality was far darker. FTX's sister trading firm, Alameda Research, had borrowed billions in customer funds from FTX to make risky leveraged bets. Alameda's balance sheet was heavily concentrated in FTT, FTX's own exchange token. On November 2nd, 2022, CoinDesk published a report showing Alameda's exposure to FTT. Binance CEO Changpeng Zhao, CZ, tweeted that Binance would sell its FTT holdings. The tweet triggered panic. Users rushed to withdraw funds from FTX. The exchange faced an $8 billion shortfall. SBF tweeted reassurances. FTX is fine, assets are fine, but withdrawals were halted. On November 11th, 2022, FTX filed for Chapter 11 bankruptcy. Customer funds were missing, eventually estimated at over $8 billion. SBF was arrested in the Bahamas in December 2022 and extradited to the US. He was convicted in November 2023 on 7 counts of fraud, conspiracy, and money laundering, and sentenced to 25 years in prison in March 2024. Caroline Ellison and other executives pleaded guilty and cooperated. Binance and CZ paid $4 billion in fines for money laundering violations in November 2023. The crypto winter deepened through 2022. Bitcoin fell to $16,000, Ethereum to $880. Market capitalization dropped from $3 trillion to under $800 billion. Thousands of projects died. Retail investors lost life savings, suicides were reported. Venture capital funding for crypto startups collapsed. Recovery began slowly in 2023. Bitcoin ETFs were approved in the United States in January 2024, drawing institutional money. The Bitcoin halving in April 2024 boosted sentiment. By February 2026, Bitcoin trades above $80,000. The market cap exceeds $2 trillion again. Regulation has tightened. MiCA in Europe, clearer US guidelines on securities, and stricter exchange compliance. Why did the crash happen? Overleverage, fraud, weak regulation, and FOMO. Centralized exchanges held customer funds without adequate safeguards. Leverage in DeFi and futures magnified losses. The decentralized promise often masked centralized risks. Lessons endure. Decentralization is hard to achieve at scale. Hype can blind even sophisticated investors. Regulation matters. Fraud can thrive in gray areas. The 2022 crypto winter was not the death of crypto. It was a brutal maturation. The collapse wasn't just a market event. It was a reckoning for an industry that promised to reinvent finance, and a reminder that trust, once broken, is hard to rebuild. Thank you for listening to this episode.